Welcome to the Principles of Finance. This course is designed to provide you with a solid foundation in finance, which is essential for making informed financial decisions in both personal and professional contexts. In this course, we will cover several fundamental topics in finance, including the time value of money, financial statements and analysis, risk and return, valuation of bonds and stocks, capital budgeting, cost of capital, and financial markets and institutions. The concept of the time value of money is crucial in finance. It states that a dollar today is worth more than a dollar in the future due to its potential earning capacity. This principle is the foundation for many financial decisions, such as investment analysis and loan amortization. For example, if you invest $1,000 at an annual interest rate of 5%, the future value of this investment after 3 years can be calculated using the formula FV equals PV times 1 plus R to the power of N. Here, PV is $1,000, R is 0.05, and N is 3. Plugging these values into the formula, we get FV equals 1,000 times 1 plus 0.05 to the power of 3, which equals $1,157.63. Understanding financial statements is essential for analyzing a company's performance. The three primary financial statements are the income statement, which shows the company's revenues and expenses over a period, resulting in net profit or loss, the balance sheet, which provides a snapshot of the company's assets, liabilities, and equity at a specific point in time, and the cash flow statement, which details the inflows and outflows of cash, highlighting the company's liquidity. Risk and return are fundamental concepts in finance. Risk is the uncertainty associated with the return on an investment, while return is the gain or loss from an investment over a specified period. For example, the expected return of a portfolio can be calculated as E of RP equals the sum of WI times E of RI, where E of RP is the expected return of the portfolio, WI is the weight of the ith asset in the portfolio, and E of RI is the expected return of the ith asset. Valuing bonds and stocks is critical for making investment decisions. The price of a bond can be determined using the present value of its future cash flows, which include periodic coupon payments and the face value at maturity. The price of a bond is given by P equals the sum of C divided by 1 plus R to the power of T, plus F divided by 1 plus R to the power of T, where P is the price of the bond, C is the coupon payment, R is the discount rate, F is the face value of the bond, and T is the number of periods. Capital budgeting involves evaluating and selecting long-term investments that are in line with the company's strategic objectives. Techniques such as net present value, internal rate of return, and payback period are commonly used. For example, NPV is calculated as the sum of CFT divided by 1 plus R to the power of T, where CFT is the cash flow at time T, R is the discount rate, and N is the number of periods. The cost of capital represents the company's cost of financing and is used as a discount rate in capital budgeting. It includes the cost of debt and the cost of equity. The weighted average cost of capital, or WACC, is calculated as E divided by V times RE plus D divided by V times RD times 1 minus TC, where E is the market value of equity, V is the total market value of equity and debt, RE is the cost of equity, D is the market value of debt, RD is the cost of debt, and TC is the corporate tax rate. Understanding financial markets and institutions is essential for comprehending how capital flows within the economy. This includes the study of stock markets, bond markets, and the role of financial intermediaries such as banks and investment firms. To succeed in this course, you should have a basic understanding of algebra, which includes the ability to solve equations and understand functions. Basic economics, which involves familiarity with supply and demand, market structures, and economic indicators. And accounting principles, which cover basic accounting concepts and financial statements. Having these prerequisites will help you grasp the financial concepts and apply them effectively. We hope you find this course engaging and informative. Let's embark on this journey to understand the principles of finance and how they impact our daily lives and the broader economy. Thank you for joining us in this course on the principles of finance. We look forward to helping you build a strong foundation in finance.